Rob's Child, no investment advice. Welcome back to the series where we go over every chapter of Benjamin Graham's The Intelligent Investor, 1972 edition. Revised edition. For a full copy of the book, click the link in the description. The purpose of this series, again, is to review the content, maybe clarify some of the things, bring the issues to a more modern viewpoint. In the recording of this video is October 2024, and I'd like to present additional insight regarding how this book compares to his sort of biblical version of value investing, second edition of security analysis, a much larger and harder book to get through. Today's episode is on Chapter 15, Stock Selection for the Enterprising Investor. This is probably a good time to bring up sort of the entire purpose of this book and the purpose of being an active investor. You know, this book, he defines how to invest what he thinks properly as a defensive investor. By the way, that does not include cost averaging. Cost averaging has worked for many decades, but it hasn't worked for all of time. But he has his way of saying how to be a proper defensive investor. And, you know, but the main point, though, is to differentiate between defensive investing and enterprising investing. Enterprising investing is to try to beat the averages. You know, specifically, how can you beat essentially the S&P 500? That's pretty much the whole point of all of this. You know, the benchmark for, you know, top tier investors is a 30% return annually. And this has been achieved by the greats, Warren Buffett, Michael Burry, and a few others. So let's move on to the chapter. Stock selection for the enterprising investor. He starts by saying, for defensive investing, they've simply focused on excluding lower quality and overpriced high quality stocks. So if there's too much assumed growth priced into it, leave it alone. And that's for the defensive investor. Now, this chapter is for the enterprising investor to find stocks that will outperform average investing. So we start by going over him saying, yes, this is very hard, and that basically no managed funds typically beat the S&P 500, essentially. Again, like SPY, the ETFs with a market cap weight index, they didn't exist. You had to like make your own version of it. Now all we have to do is type SPY and enter, and you get a perfectly acceptable defensive investor's portfolio, as long as it's not crazily expensive. Again, right now in October 2024, it is crazily expensive, but we're not going there right now. So why is it that managed funds typically don't beat the S&P 500? This gets very interesting. He concludes, well, there are two possible reasons for this. Number one, it's either the work, and this is a quote, the work of the security analyst, however intelligent and thorough, must be largely ineffective because in essence he is trying to predict the unpredictable. If you have a financial advisor, this is what he's been trained to say to you. You can't beat the averages, so don't bother. You can't, and that's a valid potential reason why managed funds don't typically beat the S&P 500. Or maybe they are handicapped by assuming certain companies will grow fast forever and others will die with no chance no matter the price. And so when we combine these two conclusions, well, where is there left to be an edge for people to actually have a chance? And that's the whole point of value investing. That's the whole point of Graham's everything. figure out where there's imbalances in the valuations of things, and take advantage of that. In his words, concluding, I quote, "The intelligent investor may be in a position to profit from the resultant undervaluations." And this has been Graham's life. Moving on, he goes over how his company, Graham Newman Corporation, made money, primarily through arbitrage and liquidations calculated to give a 20% return with a judged 80% plus success rate. So as long as they judged that, yes, there's an 80% chance that this will happen, and we're calculating that there's going to, it's going to be worth it because it's a 20% return, then, it's worth it to do that. And then also, I got to scroll out to see the bullet points properly. Yeah, okay. Anyway, the third one, related hedges, buying convertibles close to parity and shorting the stock. It's a form of arbitrage. So this is like a safe way of shorting a stock. Basically, if the stock goes up, you're protected because you own the convertibles and you just sell them and you get the bond, the bond price plus the value of the stock back, so you can get out of your short position without hardly any losses. And then, of course, if the price of the stock drops, your convertibles basically stay about the same value, and you obviously make money on the short. And then the fourth one is net current assets or bargain issues. So buying stuff that's at least a 30% discount to net current assets. I wrote a little note in here. I've been trying to use, apparently this exists. It's called an NCAV screener. I haven't exactly figured out how it works, or maybe these kinds of bargain values just don't exist anymore. I mean, his net current asset value of stocks is like ultra conservative. If he says this later in the chapter too, he doesn't even count like ownership of land or equipment as part of his calculation. What he wants, he's asking for the world with this. Apparently these deals existed, by the way, apparently in 1970, where you would have a stock valued so that even if everything that the company owned, physical stuff, land, equipment, what didn't count for anything, and the company had enough money to cover all of their liabilities, total liabilities, the leftover amount, he's saying, I want, if the stock's trading for a 30% discount to that remaining value, that's like what he considered to be a bargain issue, an absolute no-brainer, so that if the company liquidated, considering that they probably have land and other assets to sell, you'd be making much more than a 30% return on that type of operation. I've started to use NCAV screeners myself. I haven't fully figured out if there's a way to find these yet. I'm still something I'll be doing probably after I finish this book. Moving on, he discusses their history with these operations. And then I have a quote here from the chapter. As for the aggressive investor, perhaps only a small minority of them would have the type of temperament needed to limit themselves to so severely to only a relatively small part of the world of securities. This is related to an important point that you hear people talk about all the time, temperament. In order to have a very high rate of return, you have to have a temperament that can handle the kind of risk that you're taking. You have to be able to handle being wrong. Without the right temperament, it's easier to make dumber decisions, let's say. Moving on, he says that the enterprising investor basically seeks out securities he thinks are cheap based on valuation or areas he is optimistic about, but again, careful not to pay too much. Don't pay too much. And then he repeats a quote here. If he followed our philosophy in this field, he would more likely be the buyer of important cyclical enterprises such as steel shares, perhaps, when the current situation is unfavorable. The near-term prospects are poor, and the low price fully reflects the current pessimism. This quote essentially is the same exact message as the very popular adage, be greedy when others are fearful, and be fearful when others are greedy. Like right now in 2024 October, people are way too greedy right now, in my estimation. Moving on, we have a subtitle that says secondary companies. This is the second place for enterprising investors to look. Again, like secondary companies, what he's talking about basically is, I think, mostly mid caps, maybe small caps too. Anything smaller than a large cap basically is considered a secondary company. That's how he defines it. So this is an area where the enterprising investor can take a look. So he says, number one, when you're looking at smaller companies, they should have a good showing, a satisfactory past record, but appear to hold no charm for the public. So this is like the opposite of like all of the ARK stocks, right? They became so beloved. These tiny companies, many of them not making any money at all. Some of them went on to be pretty great, actually, already. And some of them are a heaping pile of debt, let's call it. But I love his statement, appear to hold no charm to the public. Again, he's not looking for something that is, bleeding money for year after year with high hopes of making money in the future. He says, no, show me that you make money and that you have a great record and that you're unpopular because no one really knows about you. That's value investing. That's Graham. Moving on, he goes on about looking through the S&P guide and says how you can find lots of crazy things going on. This was a book. I think it didn't just have the S&P 500 in it. I think it was like a more comprehensive list back in the day. Again, this is written in the 70s. And what I mean by crazy things going on is, just crazy overvaluation, crazy undervaluation. Moving on, we have another subtitle, a winnowing of the stock guide. That means like get rid of the bad stuff. So first we filter the companies to a PE ratio lower than 10. And then the second filter, similar but more liberal criteria like the defensive investor items, but notably there's no size requirement, and here they are. So this is all a quote directly from the book. So number one, what's the financial condition? He says he wants the current assets at least 1.5 times the current liabilities, and B, debt not more than 110% of current assets for industrial companies. So this is something you can find just on Yahoo. Look at the current assets and current liabilities. Do the current assets outweigh the current liabilities by 1.5? Pretty easy to do that. And then if it's an industrial company, I think it's the total debt, not more than 110% of net current assets. Very conservative valuations there. Number two, before we get to number two, one important thing to bring out about this is that, when you have a lower interest rate environment as it's been for the past few decades, even still where it is today in 2024, with the 30-year bond currently yielding around 4%. That's relatively low, especially compared to, well, the late 70s, but even the early 70s and beforehand. And so, the amount of debt, it's more manageable when yields are lower. So, companies today, they usually have a lot more debt than 110% of current net current assets. And here's the thing, a big part of that has to do with the fact that debt has been getting cheaper since 1980 in like a straight line until just the past few years. And that's why I keep saying in a lot of my shows that I think things are set to blow up. The market's not ready for this. These companies, I don't think, can handle, higher payments on their debt. When your debt is larger and the yield that you have to pay on that debt is larger, all of a sudden you owe a lot more money, when the debt's a lot higher, and then that interest payment goes up in percentage terms. Nominally, the difference is enormous. Personally, I don't see how we can have yields be as high as they are right now after having them be so low for so long, and the expectation of them to continue so low for so long. The longer yields stay higher, the more expensive this debt is going to have. The more, earnings power is going to be reduced going to the bondholders, people that own the debt. So again, with PE ratios and CAPE ratios being sky high right now in October 2024, it's like, I don't know, maybe we need to go back to a time where this was the norm. Something's got to give, but I digress. Number 2, earnings stability. No deficit in the last 5 years covered in the stock guide. So he doesn't want to see 1 year where the company had negative earnings. It seems today you see so many companies, it's almost like normal for companies to have negative earnings every once in a while. Now, of course, this has to do a lot, these requirements that he's talking about are not really the bargain deal section. This is more like for investment. Stocks that have basically, a controlled, limited downside and potential great upside. But moving on, number 3, the dividend record. So some current dividend. So you don't have to have like a great dividend record. You just got to be paying the shareholders something, and I love that one. At least be paying the shareholders something. And then 4, earnings growth. Last year's earnings more than those of 1966. I think I forgot to mention this whole example is going through how stocks were valued in specifically 1970, the end of 1970. In 1966, earnings were strong, and so the idea is that we want to see it stronger than they were in 1966, and then the price less than 120% of net tangible assets. Tangible assets being land, stuff. It's got to be less than 120%. So that's lower than a book value of 1.2. Again, this is like very low numbers. You see stocks all the time with their book value, price book ratio rather being in the hundreds. Anyway, moving on, he walks through filtering he walks through filtering, and he says out of 450, 15 meet these requirements in the S&P guide in 1970. And I put in a comment here, no computer filters, LOL, because these days, obviously, you'd be able to make these kinds of filters pretty easily with very little difficulty. He says that probably there's 150 from the full 4,500 companies in the guide. He adds that you could add a seventh, and I think he means sixth because there's only 5 things here. He says seventh. Yeah. So anyway, another filter for the S&P, saying looking for the rating of a stock, which rates by 8 years of earnings and dividend history. That's how the companies would get their rating in this guide. All right, moving on. There's a subtitle. It says single criteria for choosing common stocks. He says they tested this criteria and concludes that secondary shares, smaller companies, hurt in a downturn, and so the moral for the intelligent investor is, of course, to avoid second quality issues in making up a portfolio, unless for the enterprising investor they are demonstrable bargains. I said that word wrong. Demonstrable, like of demons, like a big bargain. I lied. Sorry. No English lessons on Rob's child. It's obvious bargain. Nothing to do with demons. Sorry about that. So the main point here is that, like, being a secondary company, they kind of automatically have higher risk. And so if you're going to be looking for reasonable valuation metrics looking at secondary companies, they may not serve you so well, because in a downturn they can really not do so well unless they're an obvious bargain deal. So sorry if there's confusion. The tested criteria, meaning that these is a sort of a bargain deal here. In this case, he defines bargain deal differently depending on the type of bargain that it is. So, but the point is that if you pick like random smaller companies from that list, in a downturn, they can lose a lot or all of their value and not really recover very well. So only buy stuff that's like an obvious correct bargain. All right, and then adds other results, and he sort of segues into talking about like large cap or mega cap stuff with a lot of goodwill, stuff that's overvalued. And he notes how no matter how much goodwill is priced into large caps or excessive value, they can perform well from market momentum. Like in 1968 to 71, and there's a quote, even if the price may appear excessive by our quantitative standards, the underlying market momentum may well carry such issues along more or less indefinitely. And there are so many examples of that today, that you could very easily point at a lot of mega cap companies today. Well, I guess even the word mega cap's kind of a new thing, right? But certainly over the past decade, even, take a look at the valuation of Apple, which seems to have an infinite amount of goodwill priced into it, and it just keeps, it keeps maintaining that amount of goodwill. It keeps going up indefinitely. I mean, it's not the kind of thing that Graham is into. He's not looking to buy something that has loads of goodwill priced into the stock price. For me, when I look at valuations of companies, I eliminate the goodwill completely. I subtract it out of the asset side of the balance sheet. I don't believe in it. I think it doesn't take a whole lot for a company to lose all of its supposed, goodwill value. It's too much risk for me. And I think that's how Graham sees it too. Actually, he has a quote here. Our own preference, however, remains for other types that show a combination of favorable investment factors, including asset values of at least 2/3 the market price. Again, I note here, goodwill isn't worth it for Graham, while bringing up specifically Apple stock and how much goodwill got priced into that. Even Warren Buffett himself, the guy that kind of, extended Graham into the realm of, finding, mega companies that'll never die. Certain prices, even for him, are too rich still today. I find that very worth taking note of. Graham is still in his head, at least a little bit. Moving on, he says low PEs, price earnings ratios, and good dividend record proved to lose less value in a downturn in a test than high PE goodwill. So a lot of companies that have a lot of goodwill in their stocks. So when the market downturns, as long as if your PE ratio is already low and you're paying out money to the shareholders all the time, well, yeah, why would it drop so much? I mean, and that's why, people always talk about in a downturn going into like more conservative stocks, stuff that can hold up because, it's paying out the whole time. Electric companies, for example, that'll just keep paying the dividends forever, public utilities, stuff like that, insurance companies. Even some REITs, although, it doesn't always go so well in both of those categories, actually. But anyway, moving on. We have a triple star rated note here. Essentially, he spells out how the S&P 500 cap weighted does better than RSP, which today I put RSP. It's what most people use I think it's the ticker for ETF of the equal weight version of the S&P 500, citing the solidity of bigger companies. So in other words, very interestingly, there was no product. There wasn't SPY. SPY is a market cap weighted index of the S&P 500. The S&P 500 index itself is market cap weighted. So when you buy a share of SPY, you're purchasing a larger portion, a larger portion of your money is getting invested into the bigger companies, and a smaller portion is going into the smaller companies. And he's saying that SPY itself basically typically outperforms the equal weighted index. And I find this fascinating because it's so easy for me to pull up those two charts side by side today. And, some people use the RSP as sort of a more conservative way of investing in stocks. And certainly today, with the amount of speculative value and goodwill priced into the mega cap companies, which, doesn't make any sense to me. I think right now is a pretty good time at least to have equal weight instead of market cap weight. SPY right now, I wouldn't want SPY right now for myself. I bring this up. It's amazing. It's amazing that he was able to figure this out in 1970. This is like before computers. He was able to figure out that market cap weighted index performs better than an equal weighted index. Amazing that he was able to do that. So that's why I put the triple stars there. Okay, moving on, we have a section on bargain issues or net current asset stock. So this is the actual bargain issue section. So the cigarette butt stocks, basically. He states The tests discussed in the last section didn't include bargain issues, defined in this section as lower than working capital value. And he said in 1968 they were hard to find, but you could find a lot of them in the 1970 decline, in which you could find many companies with more current assets than total liabilities. And it worked great between 1923 to 1957, excluding the major downturn, the Depression of 1930 to 1932. Issues like this today, I'm just going to interject here, are very hard to find. One that I found that I've brought up on my show is actually Nissan stock. Of course, you do have to count the net PPE, the equipment and land, but even at a pretty good discount, the stock's selling for 50% lower than its intrinsic value. If a billionaire were to buy the entire company at its current stock price and liquidate the whole thing, pay off all of the debt, and then sell all the equipment, even at a discount, the person doing that operation, from my calculations, would actually double their money from where it is right now. It's just over the $5 range, Nissan stock. So to me, there's not a lot of there's so few bargain issues today that even Warren Buffett says that like they're nearly impossible to find. He says that the market's been endlessly picked over. The Nissan stock seems like an extremely obvious one to me. If you want to go through the numbers yourself, you can check Yahoo Finance. Just note that the numbers are in Japanese yen and the numbers are in thousands. And so you have to add 3 zeros and then put it into dollar amounts. And you'll see what I mean. But not to get too far off topic, he says in the 1970 decline, you can find lots of deals like this. And yeah, if you were to do this for this whole time period between 23 and 57, it would have worked great. So, and then he says in 1971, even after the hard year of 1970, you could still find a diversified bargain list excluding companies with net losses. So I believe what he means by that is negative earnings. So get rid of the companies that show a negative any negative earnings record. And yeah, that's a problem with Nissan. They do have a little bit of negative earnings in their record, but what company doesn't at this point? But yeah, the point of this is just to say that you could find a bunch of these companies, even getting rid of companies that showed any losses. All right, so we have, moving on, he discusses how when things are good, people buy new issues and drive the price up to higher valuations than even the great giant companies. This is when the public is getting crazy speculative. Then when they lose, they say, oh, and this is quoted from the book, it's just part of the game. Everybody swears off such inexcusable extravagances until next time. Greed and fear, folks, when the markets are getting greedy, when they're putting enormous valuations. But by the way, he's talking about like small caps having like enormous PE ratios, which, you have a dime a dozen for those kinds of companies today, which is why I think that we're setting ourselves up in the financial world again for a heck of a correction in all asset classes. There's so much speculative value of things out there. It's just like, it doesn't seem sustainable to me. But it's commonplace now to have little baby companies have even higher valuations than giant companies in their PEs. Moving on, he says that bargain issues can take as long as 3.5 years to play out. And that's a complaint. He's saying you got to be patient for that long sometimes, because usually it's less time for the bargain to, normalize in price. And then he says, but it is well worth it. He shows an example of that occurring. We'll see if this works out for my Nissan stock. I have 5% of my portfolio in this. The idea with 5% is, it's hard to keep track of more than 20 stocks. And so my limit on single stocks is 5% allocation. But anyway, moving on. Okay, we have another subtitle. Special, I think this is the last section, yeah. Special situations or workouts. And in other words, this is another word for arbitrage. And he walks through 3 examples of workouts. Number 1 is a buyout arbitrage. The second one is the same. Third one is a liquidation. Stock value at 30% the discount when it was liquidated. And then he says in 1970 there were lots of great arbitrage opportunities. Again, if you remember earlier in the chapter, he had a calculation of how they did that with his company. But anyway, moving on, he warns that many proposed mergers actually fail. And the reasons, and that's why you have to have your 80% surety that it's going to be successful. And you don't want a 5% margin of safety. It was something, I think, 20%, whatever it said earlier in the chapter. But anyway, reasons are including why these things can fail sometimes, antitrust intervention. So basically government saying, hey, you can't do that. You're going to be too big of a company. And then shareholder opposition. So if the board says no because of whatever reason, change in market conditions, there's a million things that can happen with that. Unfavorable indications from further study or inability to agree on details and others. So lots of things can go wrong in mergers, which is why, he says in here you want to have a good experience with this and really just know that it's going to work out with 80% probability, like we said earlier. And he states here he has 2 points here, states the trick is to pick deals that are most likely to succeed. Not only that, minimal loss if they fail. So if the merger is going to fail, well, what's the worst that is likely to happen? And that's the mindset you have. Of course, you can't predict the future, but that's sort of how you have to think your way through it. And then adds to the example, these 3 examples he mentioned at the beginning that seemed like great examples. He says the first one failed. It didn't work out. And then the second one, it did work out. And the third one was a little bit mixed. He clarifies that there is risk here because of potential failure to play out. And that concludes Chapter 15, Stock Selection for the Enterprising Investor. Hope you enjoyed. Thank you for watching. And see you in Chapter 16.